Welcome to the Private Equity Exchange 2007, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. The Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. Restructuring, financial engineering in distressed situations, traditional and innovative financial instruments.
We're going to talk to you about debt restructuring. There's nothing new under the sun. But I think debt restructuring has evolved in recent years as a result of two things. As a result of an increasingly international approach and as a result of increasing diversity in participants in debt restructuring. So to introduce the session, I'm going to give a sort of quick recap of how debt restructuring has evolved over the 10 years since I've been in, or 9 years I've been in France. And then Raphaële will talk to you about some of the legal aspects, and Loïc about some of the financial instruments and the impact of the recent credit crunch. So I'm going to take you back to the 1990s. So for me, the 1990s represents a sort of base in how restructuring worked. I think probably because I can't remember what happened before that. And in a way, it was a sort of baseline, the good old days. And in those days, there wasn't much debt trading going on, apart from perhaps Eurotunnel, Euro Disney, French property crash, and a bit in the UK. And I remember, even in the UK, the mistrust with which Mr. Gary Klesch was viewed by more aristocratic members of the lending establishments. The result of that, the lack of significant level of debt trading, was that creditors were they were in situations that they didn't really want to be in, and the objective was to find an exit. Otherwise, I think the principles of debt restructuring haven't really changed. The idea is that we obtain greater value from a restructuring out of insolvency than we would in an insolvency. We need to base the restructuring on some realistic proposals for an attractive or a more attractive future than where we are now. We need to act quickly so the situation doesn't deteriorate. Try to avoid surprises. There needs to be some equitable proposal to share both pain and upside, and that's where we perhaps come to some differences between continental approach and an Anglo-Saxon approach. I put civilization rather than the old Europe. I think that was more politically correct. But I mean, we even see that hasn't really changed. Even now, you see on a Eurotunnel restructuring, you see shareholders coming out with 10% of the value of the company, when in a parallel restructuring in the UK, the nuisance value of an equity holder whose economic interest has, in theory, disappeared, may be worth 1% or something. So there are still some significant clashes between the Anglo-Saxon and continental approaches. I think in those days the established rules were the bank lenders, they wanted their money back as quickly as possible. They wanted to enhance their credit position should the restructuring fail. They wanted to ensure that their position priority be respected vis-à-vis other creditors. They wanted to control the process, if not the company. All these are slightly Anglo-Saxon approach. We had the increasing involvement of bondholders. They wanted a high coupon. They wanted low amortization of other forms of debt. And they didn't necessarily want security for themselves, but they wanted to make sure that the other holders didn't have too much. So you began to have a clash between the interests of the bondholders and the interests of traditional bank lenders. And we began to get into debt equity swaps, but those were somewhat unpopular in continental Europe because of lender liability issues. And one thing the Anglo-Saxons found when they came to France, for example, is that the classic waterfall of security rankings didn't apply in quite the same way that it does in a US or American or US or UK restructuring. So you had a bit of mutual confusion at that stage. So the good side was that you had some fairly standard rules as to who was who. The banks were the banks, bondholders were the bondholders, not much trading, established mechanism for dealing with things. The confusion was when you got to the international side, when really nobody understood how other people worked at all, and didn't really talk to each other that much. As we came into the new millennium, we've been through a learning curve. We started off with the end of the dot-com crisis and telecom crisis. We had recovery in Asia meant that people who were investing in distressed debt in Asia then came to look at low-hanging fruit in Germany and Italy, and particularly with the reunification issues and with consolidation of banking markets there. We had a series of major restructurings. I think in those, like Alstom, Rhodia, Enron, I think when we look at those, we can say, well, it was more a question of learning a lot about how other people did things rather than developing really new ideas. And the uncertainty, I mean, when you look at the Nepalese bridge there, the question is, does the Nepalese bridge turn upside down? And the answer is no. And I think that the Anglo-Saxon lenders coming into France looking at Alstom were wondering, well, how's this going to work? They were distressed, shall we say, at the way they were treated by both the company to start with and by the government, and produced and faced with a fait accompli, which in the end served their interests very well, because they ended up taking Aura. The government, the state, temporarily resolved the liquidity issues and the bonding issues, and the business, so they were created with they were faced with a situation which they didn't like. They didn't really understand how it could work, and finally it did work, and it worked in their favour. And similarly, with Rhodia, you had significant support from the French banks, which made the restructuring a success. I think if we look at financial instruments, the financial instruments, in my view, are derived to, well, a restructuring needs to first of all fix the business, and the important financial engineering is the engineering that fixes, which is a bit like what ERG were talking about earlier, is that actually fixes the cash flows. After that, the financial engineering, the balance sheet engineering can come after. But one issue that comes out of the development of a lot of money being available, and Loïc will talk about this later, is the CDO environment, and a lot of money chasing deals and securitization, and so we have more and more complex financial engineering around transactions, which isn't driven from restructuring perspective, but from a deal perspective. And the issue comes when you try and restructure those transactions. It's more a question of untangling than the important is to have something simple going forward, and the issues is in untangling the engineering that's gone on in the past. In 1953, people on the 1953 Everest expedition knew they could get to the top, well, to the South Col of Everest without oxygen. They needed to get the oxygen to get to the top, but they didn't need it to get to the South Col. Their question, was they were trying to get up to the South Col, was whether they could get to the top, to the South Col with oxygen. And my father here has drawn a little picture of himself struggling under the weight of the new apparatus. And I think we can draw some parallels in the insolvency or restructuring world of the new apparatus. We've had the European insolvency regulation. We've had changes in practically all the insolvency regimes in France, Germany, Italy, Spain, UK. Now, all of these have started with good intentions. I think they've probably been generally positive. Certainly the European insolvency regulation has resulted in administrators talking to each other and a general internationalization of the whole process, if not harmonization. But uncertainty, to do a successful restructuring, you need a degree of uncertainty. Layer after layer of new legislation creates, in the longer term, perhaps better law. In the shorter term, it creates uncertainty, and uncertainty kills restructuring. So my view on this is there is a need for a period of consolidation while we learn to deal with what we've got, rather than keep tinkering around the edges. Finally, where have we got to today? We've got to a situation where we understand each other better. We work together. We got an investment bank with multinational team working in the same time in Germany and France. All the people working in this restructuring environment talk to each other more. That's very positive. We've also got new investors, and you primarily. I think the great news for restructuring is that there are now people who really want to invest in companies in difficulty. In the past, we were more treating with how do we exit from situations which we don't want to be in the first place. And now we've got people coming, investing in businesses because they want to do that. The convergence, we're seeing convergence between investment banks and hedge funds. We're seeing an ambivalence between what part of the capital structure people enter into. So whether they want to enter into equity or debt or both. That is not without. The new money is ideal for restructuring, because any restructuring situation cannot. Most restructuring situations cannot be resolved without some form of new money. So new capital is essential. This new divergence, this new convergence between where you are and the equity structure is not without some problems. The major one of which is who do you negotiate with? Who is the lender of record? Who is the person with the economic interest? The second issue is that a lot of new players have to go up a new learning curve, especially when they're coming to deal in continental Europe. And the third issue is that there is a thing which is still not really resolved, is how do you marry this sort of ambivalence as to capital structure as to where you go enter into as to what capital instruments you enter into. And the challenge there is, if we go back to the beginning and the Eurotunnel example, the shareholders are shareholders and should be treated as such. Lenders should be treated as such. Now you get to a situation where the lenders and the shareholders can be the same people. That challenges particularly French concepts more than perhaps Anglo-Saxon concepts, and so. But maybe that also facilitates the evolution, because finally what counts is you treat a shareholder like a shareholder and you treat a lender like a lender, and it doesn't matter who they are. So there are 4 points really I wanted to make. There are well-established restructuring principles that were established in the 1990s, and it's worth going back to at the beginning of any restructuring that say, well, what is the agenda of the other people, and what do they need to get to a conclusion, a satisfactory conclusion for everyone. The second is that we've seen an increasing internationalization of the restructuring market and mutual understanding of how other people operate. That we're working through new legislation which is generally helpful but sometimes creates short-term uncertainty, and that there's a new appetite for investing in troubled companies, which is to be welcomed. Thank you.
And Raphaële Courtier, partner of Bredin Prat, she will continue the presentation about financial engineering and what are new instruments in French environment. What's going on? What evolution can we notice? You're welcome.
Thank you. Yes, I think I would like to rebound on what Chuck has said about the evolution of the market and the corresponding evolution of the legal environment. Indeed, French law has changed recently. It's fair to say that it has followed the evolution of the market rather than the contrary, as usual. Followed and not completely, which leaves a lot of gaps between the practice and the new law. However, it did change some things, and what I would like is maybe to go through the various proceedings that French law propose now and see, focus on the situation of the distressed debt holders and see what are the new opportunities for them, but where are the layer of risk or uncertainties that remain and which they would have to deal. So very quickly, I would start with the, as you may know, there are five so-called bankruptcy proceedings instituted by French bankruptcy law. I will focus only on three of them, who are three proceedings prior to bankruptcy, which are the proceedings during which a restructuring would take place, if any. So the first one, I will go very quickly through it. It's called the mandat ad hoc. It's a very informal proceeding. Its main purpose is really the appointment of a mandataire ad hoc to help facilitate the negotiation with the debt holders. It's very flexible because it is not limited by any time frame. However, it does not provide much comfort to the much security to the creditors, because there will be no judicial recognition of whatsoever form for any agreement entered into. So it's very flexible. Anything may be negotiated within this framework, but and also it's very confidential. There is a confidentiality duty on the mandataire ad hoc. So in that respect, it may be something that the distressed company may be willing to enter, but for the creditors, it remains something really not very protective for them. The second proceeding is more interesting, I think, and incidentally, it is the proceeding which has increased the most in the last 18 months in terms of numbers of proceedings of that sort, in 2006 at least by more than 200%. So this is something maybe brings something, and it is a hybrid proceeding in the way that it is still amicable, but there is a judicial recognition if an agreement is found, and this judicial recognition will provide security to the distress holder, to the creditors. So the purpose of this proceeding is, with the help of a conciliator, to negotiate and conclude an amicable agreement in order to resolve the facilities encountered by the company. One of the interests of this proceeding is that it's available to companies which are either not insolvent or who are already insolvent, although for a short time, not more than 45 days, but still it is quite flexible to see that even if you are just insolvent, you can still try to find a way to restructure your company and negotiate with your creditors without going through a real formal bankruptcy proceeding. It is short, the timing, if you have 4 months, which can be extended by 1 more month to find an agreement. But there are no restrictions on the nature of the agreement. It will include, of course, generally financial measures, but you can also include business or labor type measures in this type of agreement. So once you have reached an agreement with your creditors, and it can be any type of financial agreements, any type of restructuring financial instrument can be implemented. There are two ways to get a recognition by the court, and this recognition will grant some security on the creditors, because it will make the agreement binding on the company and on the creditors too, obviously. So the first way is to get a constatation, so it's a form of acknowledgement by the court. And the second one is a more formal validation, which we call homologation in French, from the court. Generally, there may be tension between the companies and the creditors as to whether we get an acknowledgement or an homologation. The advantage of the acknowledgement is that it remains completely confidential. There are no publication, no publicity of any sort, so the company may wish to reach only an acknowledgement, and the acknowledgement is sufficient to make the agreement binding on the parties. For the creditors, however, I think it's important that they discuss this point at the beginning of the discussions, because if the agreement provides for new money to be put in the company, it is only the homologation who will grant them the privilege of new money. This is one of the main benefit of the new bankruptcy law for creditors, maybe this super senior privilege that they will receive. The thing is that if they agree to put new money in the distressed company, this new money will benefit from a first ranking if the company goes bankrupt. If the restructuring doesn't work and the company still goes bust, they will get this new money, which has been provided within the conciliation agreement, will be senior to any other creditors, with the sole exceptions of employees and the cost of the proceedings. So I think this is something new and which is really to take into account for distressed creditors while negotiating the restructuring. By new money, it's really hard funds, so a mere rescheduling of existing debt would not count as new money, so it's really new funds, and it's new funds granted as credit loans. Equity would not benefit from such super senior privilege. However, there is no restrictions on who can bring this new money and as such would benefit from this privilege. So, for example, shareholder loans would benefit from this privilege, provided they are granted as loans and not equity. And another advantage, and also another interesting move from French regulation, is that it has restricted the risk of creditors who put new money in the situation of a distressed company, in the sense that it has restricted the notion of abusive maintenance of the credit of the company. Until then, there was always a tension for the creditors between lending new money to a distressed company and the risk to be seen as having abusively maintained the situation of the credit of the company falsely in boni, and on the other side, the fact that if you cut your credits immediately, then you are also you could also be deemed responsible for the bankruptcy of the company. So now the law has really define the three cases in which creditors would be deemed to have provided abusive maintenance of credit, and those three cases are fraud, involvement in the management of the company. Those two ones are I think, clear and speak by themselves. The third one is, again, something which we should look at very closely. It's disproportionate guarantees. It can be seen in two different ways. Either the creditors received a guarantee from a third party and the scope of the guarantee is really excessive for the credit of the guarantor, or it could also be security, security in an amount which would be completely disproportionate with the new money put in. So when a creditor and when negotiating a security package, we should always have in mind that it's important that there is a link of a proportion between the security received and the debt secured, and a too good security package could in the end turn to be negative for the creditors. Why the distressed company could oppose an homologation as opposed to a mere acknowledgement of the conciliation? It's because then it becomes public judgment of homologation. Not only it becomes public, but the court has to hear the Workers' Council before validating the conciliation. So if in the agreement there are also some employment measures to which the distressed company has undertaken to take with the creditors, it could be an issue to consult or to have the Workers' Council consult in advance. So this is why I was saying it's something that should be discussed at the outcome of any conciliation, to be sure that everybody is online and will go to the end. The third proceedings is the safeguard proceedings. I'm sure you have heard a lot about it already, so I will maybe not be too long on the principles of it. The main novelty of this proceeding is obviously the creditors committee. It's the first time that French regulation gives to the creditors a formal right to negotiate within a bankruptcy proceeding with the distressed company. There are two committees. The one which interests us most today is the Committee for Banks. And you will see that here again the law is not completely, although it's an important move, the law is still not completely at par with the distressed market and the way it has evolved, as Chuck was saying a few minutes ago. Because exactly who will be these banks in the committee? For example, what about banking claims which have been purchased by other financial institutions which are not banks, such as CLOs, obviously, hedge funds or institutions of that nature? There is a big uncertainty as to whether they should be part of these committees or not. And you will see that, especially in the case of distressed LBO, the fact that these institutions are not part of the creditors committee would mean that the majority of the bank debt would not be represented in the committee. So it's an issue for the creditors. It's obviously also an issue for the company, because the advantage of the committee is that once a decision has been reached with this committee, it is binding on all the members whether they have approved or not the safeguard plan. So if most of the debt is out of the committee, there's no purpose anymore. But still, the question is open, and in the end, in each case, I think the court. It's the court who will in the end decide whether it invites the other creditors in this committee or not. And sometimes, and it's a source of conflict, because I imagine that some creditors will want to remain outside of the committee, and they will have grounds to that. And all the time they may, on the contrary, be willing to be in and not be invited. So a source of conflict for the future. Also because all these creditors are regrouped in the same committee, it might be more difficult to reach a majority, because there will be different types of creditors with different types of strategy within the company. Some will be here with a view to try to do debt equity swap and take the control of the company. The more traditional lenders will be there only with a view to renegotiate and reschedule their debt. So lots of different type of creditors with different tasks and maybe difficulties to reach an agreement. The bondholders, they are excluded from the bank committees, but the law provides that they can be consulted separately on the plan and they can vote as bondholders separately, even if, so again a bit of contradiction, because banks are by law members of the creditors committee, but if it's a bank which is a bondholder, it won't be represented in the bank's committee. It will be consulted directly with the other bondholders.
Raphaële, and if we make a short conclusion.
A short conclusion is that I think the law has made a lot of progress for the creditors. It leaves a lot of room for financial engineering within a distressed environment, but it leaves also a lot of uncertainties for the creditors because the law is still beyond the reality of the market, and the market is changing very quickly. And so for the creditors, there's a lot of situations that they will have to face, which no answer, whether legal, not much practice also. So it's a lot of situations that will have to be dealt one by one, and the practice will consolidate this one.
Thank you so much.
Before talking about more the distressed situation and the financial engineering that basically can be used in those situations, I just wanted to take 2 minutes of your time to go back to because when you read the press today, you know, I guess that you read the FT or you read any newspaper today, the word distressed is gonna come, or stressed is gonna come a lot related to credit environment, right? So I just want to take 2 minutes to go back and why are we today in this situation? First step, I believe, is that, you know, it's been quite a few years of growth, especially on the corporate side, with company cash flows increasing and overall favorable market conditions, in particular credit markets and capital market conditions, which has led to basically the spreads that basically when you do LBO, for example, you need to pay on the senior debt or the mezzanine debt. So basically those spreads tightening have contributed to enhance the leverage factors, because when it's cheaper to borrow, implicitly, you know, at the end of the day, what is a LBO? What is a securitization? On one side, you have the assets, and you have, you know, some, I would say, some spread or some cash flows that are originating from the assets. On the other hand, you know, you have the liability side, which is the cost of the debt and the return of capital that you need to deploy to the lower part of the capital structure. I mean, and you need to match those two, right? So when cash flows are increasing and spread are tightening, so it means cost of debt, the senior part of the liability, is going down. It means return of capital is booming, right? So there was more incentive to do more LBOs, to do more securitization of all type of assets, including mortgage assets in particular. The step 2 was, well, overall for credit investor, because in the step 1, I was mentioned about the enhanced return of capital. That's for the guys who takes the equity, right? Who takes the first loss. I mean, the enhanced return of capital. Oh, that's great! I have a superb return. I'm going to invest more, and therefore there's more LBOs, more ABS, and so on. But for the classic debt holder, credit holder, I mean, the spreads have been going down and down and down. So which means that at some point there was for them a need to source rated products which had a better return. How do you create that? Basically, there's been a demand for more structured finance product. And how do you create more spread? Is with more leverage. So we entered into, I would say, re-securitization products. So what you call CLO, collateralized loan obligation is actually securitization of tranche B and C of leverage loans. So basically leverage loans being, tranche B and C of leverage loans being one part of the financing arranged to buy out companies. So basically you are taking those tranche B and C of leverage loan and then securitize them. What is ABS CDOs, or what are the subprimes things that you hear in the US? Basically that's the same. Out of what the mortgage company were doing is basically extend a loan to a home, the subprime refer to a segment of the market which is basically the low-income people. They were borrowing money to buy assets, very, very poorly collateralized. Then each of those loans were pooled in pool of 2,000 loans, create sort of asset-backed securities which were securitized, and then using the tranches of the asset-backed securities to do CDOs of ABS. So that's the re-securitization mechanism. But you were creating rated products that were providing a better return than a classic rated product, because the more leverage there is, the more the spreads. And this market environment has basically contributed to enhance the disintermediation of the credit markets, i.e. what is also referred in French as la marchéisation du crédit, where basically credit is no longer in the hands of banks, but more in the hands of pension funds and the rest of the investment community. So, but in turn, the success of those products, providing AAA, AA, single A rated products at high spreads, has fueled a strong demand for those structured products. And more, the growth has also increased a lot, the funds available in pension funds and so on to invest in those rated products. So this demand for structured product then was also driving more demand for the collateral of those structured products. And again, we go back, what is the collateral of those structured products? Debt LBOs, okay, asset-backed securities. And therefore, there's been a pressure for the arranger of LBOs or asset-backed securities to actually generate more of the collateral, which has led to a situation where I would say the underwriting criteria to create those leverage loans or to create those asset-backed securities has diminished. And that's particularly true for the US market. It's not true in Europe. The asset-backed market, the mortgage loans in the US have reached standards where basically the credit collateralization was not good enough, and that now translates into actual rates of default. So now that we have done those 2 minutes recap about what has led us to this market, we are today in a market, especially credit markets, all the rated instruments, where there has been a sharp drop in value on those assets, and we start talking about distress situation or situation where distress funds are being raised and so on. So what I wanted to do is first, I've put in brackets the word distressed, because what is distressed? I think it's a bit used, a bit abusive at the moment in the current market, because if we look at the credit markets, which is basically leverage loan, high yield, asset-backed securities, CDOs, and straight bonds, basically the real concern, the real credit concern, where there are actual defaults, are very focused on one side of the market, which is ABS, US ABS, US asset-backed securities. That's the only place where the default rate is rising sharply today. And all the rest, there's a contagion effect, since the market is basically, those are rated securities, so there's a price, and the rest is, I would say, contaminated by the press, the pressure of shareholder who wants to disinvest from overall credit markets, and therefore you have very sane, very safe assets which have basically migrated in price. And today you can find European leverage loans where cash flows of the companies are performing exactly as per the plan, and where the loans are trading 92%, right? So I'm talking about B and C tranches of leverage loan, for example. So those are classic double B tranche of a leverage loan. So I would refer all those opportunities as more the stressed opportunities, because it's more of a performing asset with a stressed price. Okay, there are opportunities, funds are being raised here, and that's, I would say, almost of a trading gamble. It's a trading game, right? You bet that basically the fact that the market has been, there's been a contagion effect on performing assets, they will come back to more reasonable level as they were 102 or 100%. Okay? So that's the first opportunity. And then there is the real, I would say, more private equity-like situation where you can find assets which are having trouble, okay, where they are in the collateral, where there are actual default and credit concerns, and those assets are trading 20, 30 cents on the dollar. So I would say what characterizes a distressed opportunity is two things. You need two things. You need a sharp drop in price, and often people, when they look at distressed opportunities, they stop here. Oh, okay, it was worth 100, it's worth 20 cents. There is a distressed opportunity. Well, that's the second point, which basically is obvious, is that, well, we need to make sure there's value left. And we need to make sure that we are certain that basically those products will go back to par value at maturity, or actually will basically double in the next 2 years if there is a. And when it comes to the structured finance world, actually it's rather digital. Either it goes to zero or it will go back to par. Right? But the kind of bet saying, well, it's worth 20 cents, I'm going to sell it at 35 in 2 years. I mean, it's kind of betting of a sort of market volatility. So I would say the sound distress situation opportunities today would be based on, and you use actually the strategy of entangling the complex product is basically going back to basics. What it is to basically do distressed, seeking distressed opportunities is going back to basics. So it's having the ability to basically go back in those structures, look at the actual cash flows, look at what's performing, and so what is referred as look-through, cash flow look-through situation for all those structured products, and basically come back and look at the value opportunities. When it comes to financial engineering, as we've seen in many of the debt restructuring situations that took place in the past 10 years, I mean, you mentioned a few. I've worked on situations like Indonesian bank balance sheets, which were completely distressed and almost bankrupt in 1997, 98, or Thailand, the situation in 98. I mean, those cases were quite specific and not really appropriate to Europe, because in most cases, the engineering used to kind of for the distressed buyer has been to buy the assets and basically switch that into long-term product, where basically you had a sort of a defeasance mechanism that were allowing you to amortize the loss, over 20, 25 years. Usually, those were possible in an environment where I would say the regulatory and accounting pressure is actually looser than it is in continental Europe. So I would say the opportunities today, on addition to the back to basics, going back to cash flows of the products, even though they are structured, it's always possible to go back to cash flows, provided you have the expertise to do so. Then it's more like what happened in Italy. You mentioned Italy as well. There was structured product. What you do is the way to restructure them is also sometimes to put back all the pieces together and going back to the collateral. So trying to sell in parts and come back to the actual collateral, so that you have a better grip on them and you are able to extract the value on a shorter in a shorter period of time. So as far as the techniques and the engineering used, a lot is going to refer to what is referred as synthetic as opposed to cash assets. So I mean using derivatives, and in particular all the credit default swap mechanism, which usually are bilateral between parties. And I agree fully with you. I mean the prerequisite in sourcing, because once you have identified what could be good in a distressed situation, the most important is being able to source them in adequate conditions, is to understand the motives and the rationale of the current debt holders. They can be driven by accounting issues. Yes, I have in my balance sheet something that is valued at 90%, as most of the financial institutions today, while actually the market value is probably 20 cents. What do? Do I lose my job and basically account it for for 20%, or do I find schemes which are basically accounting compliance, but basically which enter into a sort of the scope of those distressed opportunities? It may be simply that you're no longer comfortable with the risk. You may be holding an asset that is worth 60% and is going potentially can be going with the contagion price to 30%. But a distressed buyer might have the view that, yeah, but this is a performing asset. Yes, there is a contagion effect, but it's worth being in a distressed fund. So that's going to be the second, would be more risk, mark-to-market risk relation. And the third thing can be, and that's a lot for all the German banks, especially the Landesbanks, it's more of a liquidity. All those assets are basically, are cash assets in most cases. So banks are invested and are mobilizing a big part of liquidity. And as you've seen over the summer, the credit crunch has also affected the ability for financial institutions to raise the money they need to finance their balance sheets. So, I mean, there's also an angle here, which is that you have a lot of liquidity, short of liquidity banks, especially in Central Europe and Germany, that actually have more pressure to sell those assets. So, I mean, I'll always put the engineering of distress situation and the sourcing, where you understand the motives, as you said, which was your first point on the agenda, as the really two drivers of putting together distressed opportunities, which I really believe are currently an attractive market angle. I mean, it's very important to do it with the right skill set, and to also do it, to be equipped to manage the timing right. Because, I mean, if you have the right skill set, they're going to tell you, well, you need to be equipped today. But basically, maybe most of the opportunities will come in 6 months or in 12 months and so on. Depending on the asset class we're talking about, probably that in structured finance, US structured finance, the opportunities are more in the next coming months. But as far as all the leverage finance is concerned, where there will be opportunities, especially also in the US and European market, it's more probably 12, 18 months down the road that basically the beginning of the opportunities are so. That were my few points. Thanks.